What a banger of a day. Unbelievable stuff is happening. Jerome Powell, this guy right here, is just pounding the market over and over again. Now, some of you are very, very excited because he is pausing rates. I'm giving away the end of the story here. But if you continued on and read into it, they want to raise the rates a lot more during this year. It's a very hawkish pause. So let's get into it because, man, I got to go over this with you. He gave a very, very long presentation. He left a couple bombs in there that I want to point out to you. And I listened to the entire thing. I read all the minutes and the producer index, so you don't have to. We're going to summarize it all for you right now. All right, so let's start off with number one, his speech. And I'm going to tell you right in advance, in the first couple minutes, this guy is going to tell you a lot, okay? And so I'm going to try to tell you the important parts as we go along. All right, so let's start off with him right now.
We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal.
It has to come to 2%.
Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all.
Okay, now here come the big ones.
Since early last year, the FOMC has significantly tightened the stance of monetary policy. We have raised our policy interest rate by 5 percentage points, and we've continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. In light of how far we've come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, today, we decided to leave our policy interest rate unchanged.
Okay, so I got to stop you right there because these are all of the bombs. Did you catch all of those things that he threw out there? Because I think that they're super, super important. Let me help you break them down. Okay, the first thing that he keeps talking about is the lag effect. Did you hear that word? You're going to hear this over and over again. The lag effect. It takes up to 18 months after the last lag actually hits for it to happen. He said this all in the first minute. Okay, second thing, he is dumping securities. So number one, when you hit the economy, number one, by higher interest rates, it smacks the economy hard, okay? Second step, though, they are selling their securities, okay? So they're tightening their books. This also puts a drag on the economy, two drags at once, 1-2 punch, okay? So he keeps talking about that, but then he mentions credit tightening. Now, I hate that the Fed always uses all of these fancy words. It's not just them. The European Central Bank, Bank of Japan, Bank of Canada, all of them are always saying the same thing. What does that mean? That means that they are not lending to people anymore. Me and you, that when we go to the bank to get a mortgage, they're like, well, before we wanted a 700 credit score. Now we want an 800 credit score. Last year, we wanted you to make $75,000 a year. This year, we want you to make $250,000 a year for the same mortgage. That's credit tightening. They're increasing their standards, okay? That is very, very important. Also, he goes on and he drops a couple other bombs. I just wanted you to understand those ones that he's starting off with, okay? Now, let's continue with this guy because I feel it's a doozy, okay? All right, let's continue.
And to continue to reduce our securities holdings. Looking ahead, nearly all committee participants view it as likely that some further rate increases will be appropriate this year to bring inflation down to 2% over time.
Okay, so big time, you got to hang on to that. What is he telling you that's going to happen? All the committee members are saying later in this year they have to raise rates, and he wants to save it to the very end before he's going to bomb you with that information. So he's like, we will pause for now, but it's going to get a lot worse a little bit later because all of the indicators that they're looking at right now, they're not doing it for them. It's not enough. They need more pain. Unfortunately, I mean, that's just the way it is. All right, so let me continue on. So going to raise rates farther, all right? So let's go to the next point that I have for you at 240.
Easing and job vacancies have declined so far this year. While the jobs to workers gap has declined, labor demand still substantially exceeds the supply of available workers.
There are too many jobs.
FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on inflation.
Okay. I mean, you guys, they speak their own language, right? Their own language always has these weird new things that you have to kind of understand what they're saying. They're saying that wage spiral or wage growth is going down. What that means is people are getting poorer. They're not paying you as much on your salary. Number two, they're saying there's too many jobs out there and they expect the labor market to soften. So you and I, tell me what that means. Soften. It means a lot of people have to lose their jobs. And so how many in Canada? They want 200,000 people around to lose their jobs to come into balance. The United States, 2 million people to lose their jobs to come into balance. You tell me, what is the effect when 2 million Americans, 200,000 Canadians all lose their job? I mean, nothing good. Honestly, like you tell me, nothing good can come from that. Okay, so let me continue on to my next point right here.
CP for total PCE inflation is 3.2% this year.
Oh, hang on.
2.5% consumer price index came in at 4%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.2% this year, 2.5% next year, and 2.1% in 2025.
Okay, you got to know that. You guys, very, very important for you to know that. So he is saying that these rates are going to stay a lot higher for a lot longer. This is what he's saying. Okay, so he is saying we are watching our inflation numbers right now. Our inflation numbers are super, super important. What are they? And the CPI came in at 4.4, much hotter than they want. And core inflation, which has no energy and no food included in it, which is crazy. What kind of alien doesn't use fuel and food in their life? But even core inflation, which is like services, 4.7, double what they want, more than double what they want. So they are watching this like a hawk, way too hot. And so he says, we think inflation is going to come down by the end of the year. If we can get 2 million people to lose their job, inflation will come down to 3%, 3.2 this year, 2.5 next year, 2.1 the year after. What does that tell you? He is intending to tell you that these rates have to stay high for a lot longer than you think. 3 years out. Do I think that they're going to be able to hang on to these super high rates for 3 years? I don't believe there's a chance in hell that they can do that. But this is what he's trying to signal the market. Let's play the devil's advocate for a second and go on the other side. What happens if he said to you, we intend to drop rates down to zero, at the end of the year? Just imagine they said that. There would be this stampede of 1 million people running to buy homes. And guess what would happen now? The market would absolutely die. And then as 1 million people go and buy homes at Christmas time, then there's going to be inflation like crazy. Well, I can't have that, right? That doesn't work. So he is saying this is going to last a long, long time. This is what your takeaway has to be, that what he is mentioning. Okay, let's go to, and then he's got a couple questions. He's only got a short statement.
Far we've come in tightening policy. The uncertain lags with which monetary policy affects the economy and potential headwinds from credit tightening, the committee decided it.
Did you see again? He's mentioning tightening, like they're not giving loans to just anybody. And second point, the lag effect, which I'm going to show you guys in a second right now. And here is, I think, the biggest bomb that you guys got to pay attention to right here, where he tells you what he thinks is going to happen by the end of the year.
If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year.
Are we not paying attention to that? So he's going to pause right now. Okay, he's going to pause right now just as a gift to you, but he's got to raise a couple more times this year. He has to have it land at 5.6% by the end of the year. What does that mean to me and you? That means that if you're in Canada, you got to be expecting an interest rate of 7.5%. If you're in the States, you could be seeing 8.5% as the advertised rates. But on top of these advertised rates is what they keep talking about, credit tightening. Let me give you an example. I had a client of mine that he goes to the bank. He's looking for a $250,000 line of credit. He has good income. They wanted $1 million of collateral from this client. $1 million as collateral to give him a $250,000. Well, you would not have even heard of that a year and a half ago, not even close. If you have a credit score of over 800 and incredible stable jobs, now all of a sudden your mortgage rate's going to be 9.5%. The banks are telling you that you have to be triple A, cream of the crop. But I've never met somebody who can get that. All of the people that I know are getting mortgage rates of 8s and 9s. So imagine what it's going to be when it's almost 3/4 or a full percent higher than what it is today. Woo! This is some serious stuff. Okay, so let me break down a couple things I want to show you about what is actually happening. So, thank you very much, all the people who are on YouTube, who are on Instagram, who are on Facebook, who are on TikTok. We really appreciate it. And we're going to be able to get to a lot of your questions very, very soon. So these rates are going to be going up a lot higher. So let me share with you a couple of the screens that I prepared. I prepared a lot of things for you. So hopefully you will really appreciate what we did. Thank you guys for the whole team for helping us put all of this together. We really appreciate all of your efforts. So let's continue on with this. If we want to go and take a look at the producer price index, when we are driving a car, we like to look out the front of the window. We don't like to look behind, right? We don't look out the rear window. We only check every now and then. CPI inflation or consumer price inflation is looking out the rear window. What happened in January, February, March? Producer index is what are the producers making. So when we look at the producer, a lot of people are looking forward and to see where this is going to be moving in the next few months. One thing that you can see is as these producer indexes, look at this, they were as high as 17, 18% a year ago. And as these interest rates have been crushing them, we can see that it's having its effect. And producer index now, starting this spring, started going just below zero. This is very, very predictable. We're expecting this. But why would we not only look at CPI inflation? And I think it's important that you ask that question. If you continue down in the minutes, you don't have to. You could just do it with me. It talks about the CPI, which is looking backwards, and PPI in the forward. And it says that PPI or producer index, remember, it's people that are making things in the States. It excludes all imports because they're not making them. Well, that's a big thing. Canada and the States import a ton of crap. Also, if we look at CPI, the most heavily weighted item is equivalent rent. Of course, we're not producing rent, right? So it doesn't include it. So this is just one window that you have to look at. Okay. When we're going to be looking at bonds, that's a separate thing. So this is closely tied with your mortgage rates. If we want to go back to year to date, we want to look and see where they are predicting that rates are going to go and look at them. They were predicting that's going to go up. As of May 11th, they already knew that Canada was going to start raising rates again. And so look at the smart money knew this, and it started taking off long before last week when they actually announced that there was a rate. So if you want to know where rates are going, pay attention to the 5-year government bond, whatever country that you're in. If you want to look at the gilt market in the UK, or you want to look at the treasury market in the States, it's the same thing. So if we look at the United States, they peaked at 7% average 30-year fixed rate mortgages if you go back in time. But now they're going to be getting close to that again. In Canada, we don't have that actually. In Canada, we got this weird thing where we can't lock in our rates for 30 years. In Canada, what we do is we lock it in normally for 5 years, or we just might be variable, one or the other. So let's take a look at what is happening in Canada, but this should just be flagging what a lot of the other countries are doing. Remember, the United States is the king of the world when it comes to finances, all right? The sun never sets on the United States in the financial world. But we have something called the yield curve inversion when it comes to the treasury rates. If you lend money to the government for 10 years, you expect to make more money if you lend it to them for 10 years than if you lend something to one. I mean, you're taking on more risk. So when it comes to fixed rate mortgages and variable mortgages, this 5-year fixed rate security blanket that you get, that comes at a cost to have a security blanket. But look at it now. It's so inverted, it's disgusting. It's unbelievable. How can it be a full percentage point more for you to go on variable? What I can tell you is that this is a sign of a very sick market. It is not healthy. There's something very, very wrong with that. If we continue and look at Canada, Canada was extremely arrogant back in the beginning of the year where we paused rates a couple times. If you pause rates a couple times and don't follow the states like you're supposed to, you can see in March and April, they decided to pause 2 times. And then they got a lot of egg on their face right here as they had to raise the rates again because they are stuck. They have to follow the United States. When we take a look at the states, they nonstop up, up, up. Every step from last year, 10 rate hikes in a row. Canada only did 8 in a row and then decided to pause, and now they got that egg on their face. So they're going to have to catch up to where the United States is. 4.75 is where we're sitting at right now, and the United States are sitting at 5.25. They have to catch up to that. That's where they got to go. So let's see, guys, if we want to see what is going to happen with real estate. This is the number one question. You guys know that I sell real estate and I invest in real estate. I'm a real estate broker in Toronto, but we invest all over the place. So if we take a look at a loan here for $1 million, $1 million at 2% last year for 25 years, it's a $4,200 payment. People's salaries have not changed. It's the same, $4,200. Look at what you would have to be at a 7.5% mortgage. You would have to have $575,000 home to have a $4,000 mortgage. And so that is the difference. You need to have home prices adjust or salaries adjust, your choice, one of the two. All right, so let's continue on. If we take a look at the risks, Canada right now is the highest risk country at a threat for home prices to actually go way, way down. United States is sitting way down in 6th place. A lot of the countries at the bottom that don't have as much risk are places that you would not be thinking of. Slovenia, Slovakia, Italy, so forth. Hungary. You wouldn't think normally of going there. But this is looking at the country as a whole. If we take a look at just the United States, for example, and we removed New York, San Francisco, Chicago, Miami, Atlanta out of the picture, it's a completely different map. Canada, if you just removed Toronto and Vancouver out of the picture, the whole country's numbers would change. The punishment is mostly going to come in these big, overpriced, bloated places. That's where it's going to get hit. So how long? They keep talking about the lag effect. So please go to Investopedia and look up response lag. I always bring this up. It takes 18 months from the last interest rate hike. So we are not even close to that. We're going to be seeing this over the next 18 months from now. And this is what the government keeps on talking about. If we want to look at the consumer price index that just came out, it is actually very, very hot, 4%, very, very hot. It is not getting any better any sooner. All right. So you guys, I tried to make it very easy for you, and I wanted to narrow it down so that you guys have an idea of just let's break down the main points that you really need to pay attention to right now, so that we know exactly where we are and exactly what you have to do, okay? This is where we're at. The full effects have not been felt yet. The full effects have not been felt. And this is what I'm talking to you about, the lag effect. That lag effect is 18 months since the last rate hike. Please remember that. This will continue to push the markets down. 18 months from the last rate hike. And they're mentioning that there's 2 more rate hikes this year to come. Canada has 3 or 4 possibly to go. So if that's going to happen, we got to, from the last rate hike, count 18 months out from that, and you're going to see what's going to happen. I have a graph to show you in a second. A credit tightening is happening right now. What is credit tightening? No loans, meaning no mortgages to anybody. I can tell you exactly. I mean, exactly what's going to happen if nobody gets a mortgage. If nobody can get a mortgage, home prices are going to drop like a rock. That's what I want you to know. Home prices are going to absolutely crumple. Just imagine that only 10% of people buy with cash. If you take all of that away, it's over. I'm telling you, it's over. Okay, so likely more credit rate hikes. What are they saying? 5.6% is where you're going to be. 5.6% is the Fed rates. So that means a mortgage rate of about 8% that you got to be looking for, maybe even 9%. I wouldn't be surprised if we're already breaching 10s. I have seen 10s already today. So if we have to raise rates a full percentage point from where we are today, 10s are easily going to be there. Other points that the Federal Reserve or Jay Powell right here keeps talking about is salaries are slowing. So as salaries are flattening out, people are not getting raises anymore. But he keeps mentioning that there's too many jobs. So I just want you to think about this. If there's a lag effect, that's going to push home prices down in the big cities. Big cities. I'm specifically pointing out cities over 1 million people. If there is a lag effect, it's going to hurt big cities. If there are no loans, it's going to hurt home prices. If the rates are going to go to 8, 9%, it's going to hurt home prices. If salaries are not growing, that's going to hurt home prices. Too many jobs in Canada, they want 200,000 jobs to be lost. In the USA, they want 2 million jobs lost. You tell me what's going to happen when that many people can't afford their mortgages. Honestly, I mean, I don't have to be a genius just to figure that one out, right? Honestly, it's not going to be very, very good. So where are we sitting today? They said very flat out 4.4% inflation today, and core is 4.7. This is services. Okay. So where do we have to be? You guys hear it on the news every single day. 2% is where we have to be. 2%. He just says it every single day over and over again. So where does he expect this to be? 3.2% in 2023. He expects 2024 to be 2.5%, and this at 2.1. You don't have to remember this. That's a pile of malarkey. You don't have to remember that. What you got to know is that these rates got to stay higher for longer. And they're expecting this massive increase to 5.6 by the end of this year. That means several more hikes that are going to be coming. Will that mean a July rate hike? Most likely it's going to be. So let's take a look at how this behaves. When we are looking at this green up here, this is homes in dollars, okay? And down here, this is the rate. As you see those rates come up and up and up and up and up and up, all the way up, home prices resist it. They resist it and go, you can't be serious. You can't be serious. You can't be serious. And then once it starts getting to the top, then prices start aggressively coming down. But they usually are, the governments are not proactive, they're reactive. So as home prices are crashing and the economy is going into serious doo-doo, then they're going to start see these rates are getting lowered. And then you're going to see a delay before home prices start picking up. There's always a delay, always in homes. So core inflation, what they're talking about, they're saying it's flat. There's no progress. It's been 5% for month after month after month. So which also tells you they got to be staying on it for a while. So let's just say we're going to take an example. Let's just say I personally, David, me, myself, I'm clearing $4,000 per month on my salary. Now the bank over here, not Bitcoin, the bank is saying, David, here is the rule. 30% of your salary, 30% of your salary can go towards housing. Guess what? That's what the law has been forever. That's how banks operate. 30% of your salary can go to housing, period. 30%. All right. So what happens if your mortgage is 1%, David, like it was, a year and a half ago? Well, the bank says 30% of your salary can go to housing, David. Oh, David, well, what happens if it was just 1988 and mortgage rates were 20%? What about then? Well, banks are going to tell you, 30%, David, is the rule. They don't care about what the home price is or what the interest rate is. What they care about is that you'd never go past 30% of your income to pay for your home. The rule doesn't change. We change. Prices change. Our incomes change. But their rules of 1/3 of your income from housing don't change. So if you can follow this rule, you're going to be okay at the end of the day. And here is what you got to remember. Either housing has to drop 40% to counteract that, or you have to get a raise of 40%. So you tell me which one is more likely. Either home prices got to drop, or you're going to get a 40% raise. You tell me. I don't know. I can tell you that they're mentioning right now in these same talks, right? Guys, this is very serious. We're in a lot of doo-doo. This has got to continue. And so they're going to say, well, there's no more raises. Even the Federal Reserve, Jerome Powell himself is saying that wages are stagnating. So where is the 40% raise? There's only one other solution. Do you remember when we were looking at the prices for those properties? Let's try to jump back into that because I want to make sure that we were on the same page. When we were looking at that calculator, it was telling us what those loan values are. So for you to have a $4,200 payment last year and a $4,200 payment this year, which means that you have to be clearing $12,000 a month, which already, who does that? Home prices would have to drop from $1 million all the way down to $575,000. What is that? That's a 43% drop in prices for the payments to stay the same. Now, what happens if this goes up even higher? Then that means home prices got to drop. This is how. So when you guys look at these stories of, way back when your parents bought a house, blah, 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 interest rates were 20%. Yeah, but home prices were way lower. You could never, if interest rates went to 20% today, I can tell you already, home prices would drop to the floor because nobody could afford it. But there'd be a lot of mayhem in the middle. All right. So let's go back. I have two more things, and then I'm going to take some questions from you. Okay. Two more things I want to share with you that I prepared. And I think they're honest questions that he's talking about. Okay. Honest questions that he wants to let us know about what he thinks is going to happen in the future. These are the reporters that are mentioning it. So let's go to the first one, 2230. And he's talking about the bond rates. Remember, I just showed you the bond rates a couple minutes ago. Let's take a look at what he says.
That's what we want to see. Of course, that's what we want to see. And I think it's also, we understand that there are lags, but remember that it's more than a year since financial conditions began tightening. I think the reason we're comfortable pausing is that we are still, much of the tightening took place over last summer and later into the year. And I think it's reasonable
to expect those lags to come into effect.
Yeah. So
This one.
It's a challenging thing in economics. It's sort of standard thinking that monetary policy affects economic activity with long and variable lags. Of course, these days, financial.
Did you hear that? That policies are affected with long and variable lags. It takes a long time, a year and a half, okay, for you to feel the pain. We're not even there yet.
Conditions begin to tighten well in advance of actual rate hikes. So if you look back when we were lifting off, we started talking about lifting off. By the time we had lifted off, the 2-year, which is a pretty good estimate of where policy is going, had gone from 20 basis points to 200 basis points. So in that sense, tightening happens much sooner than it used to in a world where news was in newspapers and not on the wire. So that's different, but it's still the case that what you see is interest sensitive spending is affected very, very quickly. So housing and durable goods and things like that, but broader demand and spending and asset values and things like that, they just take longer. And you can pretty much find research.
Did you hear that? I mean, like, I don't know about you, but it kind of jumps out at me like a ton of bricks. So he's talking about assets and purchases. So let me break that down for you. If I'm looking for a house and my mortgage was approved for me today, okay, and it was good for $1 million, and then tomorrow I find out that the interest rate has gone up, my mortgage broker will call me the same day, and call me and go, hey, David, you can't get $1 million anymore. You can now only get 900,000 immediately. So for buyers, it is immediate. And that's what he's saying. Immediate for those people who are spending the money today, right away. But assets lag, meaning the sellers take a long time for them to come to grips with that and understand what is happening. So for buyers, it's instant. For sellers, it takes a long time. Did you see when I did that map of the little red line of the rates going up? It takes a long time for that price to actually adjust. And then once it starts adjusting, it's like a snowball that kind of goes off a cliff. And so he is just reiterating what we all know on this channel anyway, right? This is what we follow. Okay, so last one. Thank you very much for your patience, guys. He's just telling you what you can look for. What should you look for if you want to know where he's going to go next? And he actually says it in here, where to watch, the next thing to watch. Okay, listen to him.
Forecasters have consistently thought that inflation was about to turn down, and typically forecasted that it would, and been wrong. So I think if you look at core PCE inflation overall, look at it over the last 6 months, you're just not seeing a lot of progress. It's running at a level,
There you go. He said it. Core CPE. So just go look at core inflation. He says, if you look at it at the past 6 months, it's flat. It's not moving at all. And that's what we see. Core CPI is services, right? It's not energy because that's very volatile, they say. So it's just mainly services, and that inflation isn't moving. So even more fire for them to say, we're going to keep the rates higher for longer and raise them more in the future. So if you really want to know what is happening, go look at the producer price index. Number one, go look at core inflation because these guys absolutely love it. And go watch what the job numbers are. They want more people to drop their jobs. So, I mean, sheesh, crazy. Absolutely crazy, you guys. All right. Thank you very much for always supporting the channel. If you're looking to sell your property and you do live in Toronto, you can always reach out and contact me. Otherwise, thank you very much for supporting us. Thank you very much for following the channel. Please consider subscribing, hitting that notification bell, and we'll talk to you soon.